Hey, Michael Wolf here. We're going to talk about prepaid interest. Now, let's say we have a purchase transaction that was closing on January 12th of 2021. So that it would be closing right about here. Now, your first payment on this new loan wouldn't be due until March 1st. And like all mortgages, the interest is paid in arrears. That means when the due date comes, you're paying the interest that had already accrued for the month prior. There we go. So March 1st payment is paying the interest that started accruing on February 1st. But hey, we closed on the 12th. What about the rest of January? Well, you have interest due on the day of closing through the end of that month right there. Now, your new loan, let's say, is at 2.5%, which would give you 20 days, based on this scenario, $20 a day of interest. So $20 a day, 20 days means you would owe $400 at closing. But then your first payment, your full mortgage payment, won't be due until about a month and a half later on March 1st. Now, what about a refinance that is also closing on January 12th? Well, the same applies. You would have your first payment due March 1st, which would cover all the interest due in February, and any interest that was due for the remainder of the month of January for the new loan, since you don't have a payment February 1st, will be collected at closing of $400. Let's talk about the loan that existed before. You would have had a payment due on January 1st, right? So on January 1st, that would have paid the interest that accrued in December. There's December interest, but you did not make your January payment yet, which is fine. But you still had all the month of December due, and because you didn't pay off that loan in full until the 12th, you have all these days here of Ronald's interest. So your old loan would have your old loan would be 3.5% mortgage interest rate at $30 a day. Now you would have had that for 42 days. So you would have owed, instead of making a January 1st payment, you would have owed at closing $1,260 of interest for the old loan, and that would be in your payoff for the old mortgage, right? So you would have a total of interest due, $400 for the new loan collected at closing, $1,260 also collected but in the payoff demand of the old loan for $1,660. So if you made your December payment on time and you refinanced in January, that means you would have kind of skipped January payment and February payment. However, you did not skip it, you just didn't pay it out of pocket, but you're absolutely 100% still paying that interest, just not out of pocket. Hope this answers some questions and clarifies what interest is and isn't due on your mortgage.